Hey guys, how you doing? This is Tyler Gracey, William Pitt Sotheby's Seaport Real Estate Group. I have a couple guests with me here this morning. You guys want to introduce yourselves? Tell them a little about where you're from and who you're with.
Yeah, Erik Johnson, Harbour Mortgage Group from Mystic, Connecticut, Vice President.
Charles Gorrondona, Area Manager for the Guilford office with Harbour Mortgage.
Very good. So I have these guys here with me this morning. We're going to go over a few lending tips for the first-time home buyers. So basically we're just going to jump right into it. Number one is going to be know your credit and what that really means for your mortgage. So if you guys want to kind of touch on that a little bit, what does the credit score really mean for your mortgage?
Well, there are categories like in credit scores, just like anything else. 760 to 800 plus is considered the elite status, the highest, and you would get the most favorable loan terms. From 701 to 760 would be average, good, and below 700 to 600 maybe would be moderate and something that might need a little work, and below 600 would be credit repair.
Okay.
Yeah, and it's important to know your score when you go into a situation such as buying a home. It can make a big difference between having a 600 credit score and having a 700 credit score. Could mean difference of hundreds of dollars in your monthly payment. So it's good to know you can go online and get one free credit report per year, or you can give us a call and we can go over the details of your credit with you at harbormortgagegroup.com. Just so you can look us up.
Yep.
And but it's very important that you do know your score and what's in your credit report, because if you're not looking at it, then you don't want to have a surprise come up at the last minute.
Yeah,
so
definitely.
And leading up until the event itself, when you decide to start looking up to start applying, there are things that you shouldn't be buying your furniture before you buy your house.
Definitely.
You
Hold
shouldn't
off.
be getting a new car to go look for a new house in.
Right.
So these are just kind of things that you would naturally assume people would know, but oftentimes they forget.
Right. Cool. That kind of leads us into number two, which is really knowing what you can afford, and that kind of plays a role into like the debt to income, kind of knowing your overall, standing financially. So that kind of, right? I mean, is it? How do you figure out what you can afford? Is that a combination of your credit score and knowing, what your credit limit is?
Before coming into the mortgage business, I worked for American Express, and we couldn't sell an insurance policy until we did a financial plan, because it was believed then that unless you know the total picture, you can't represent or recommend a specific one item, because it is affected by everything else in your financial situation. A mortgage would be equally as important as an insurance policy.
Right.
So it would involve a consultative approach, meeting with the realtor and the mortgage loan originator, and thoroughly discussing the assets, the liabilities, not only as they exist today, but in the immediate and the long term.
And another thing to add to that is there are a lot of different programs that offer different debt to income ratios. In general, you have two different debt to income ratios. You have your housing ratio, which is considered your front end ratio, and you have your total back end ratio, which is inclusive of the housing ratio plus any other debt that you might have, credit cards,
like
car loans, your total picture. A good guideline is to keep your debt to income ratio no more than 42 on the front, and in general no more than 55 on the back end ratio. There are programs that allow for higher, but in general that's a pretty good area to keep yourself where you're comfortable on your monthly payment.
Okay. Yeah. Okay. Number three is going to be knowing your assets and liabilities. Kind of, where do you spend your money every month? What does your cash flow look like? It kind of leads into that debt to income as well.
Yes.
So that's kind of a simple one. And then four is going to be kind of knowing what you're going to be able to put down, and then how to estimate your closing costs and kind of get an idea of what you're really going to have to come up with out of pocket.
Sure. So when it comes to the down payment and the assets, it's important that you know that there's, again, many different programs out there. We have 100% financing programs. We have programs that you can put down as much as you like. So with the asset, you have to make sure that the money is in the bank.
Right.
Cash is bad. So You don't want somebody coming in with a bag of cash to do a down payment because
you don't know where it came from.
It can't be documented, so that can't be used. So it's important to have somebody like a mortgage loan officer review your assets to make sure that there's going to be no surprises in it, because as a first-time home buyer, you don't want to be stressed.
Right.
You know, it's important that the process is as smooth as possible, and we strive to do that on every single transaction. So.
Yeah, basically, closing costs are what you need to bring to the closing at the mortgage.
Right.
Is usually three things: the balance of the down payment. Second thing is the cost associated with the transaction itself, and then the third thing is the escrow that might be needed or required. So those things are the way it's usually divided, and you always get a truth in lending statement prior to the closing to tell you exactly what that dollar amount is.
And just one more thing to add to that is to know how much you need. A big part of that is your closing costs. In general, a good rule of thumb is 3%. 3% of whatever the purchase price is typically going to be roughly what your closing costs will be. Now, there's a couple of ways to handle your closing costs. You can pay them out of pocket, or you can have them paid by a seller concession.
Right.
So those are things to consider
Lots
as
of
well.
options.
Yeah.
Right. Okay. And then lastly, 5 is going to be, and I know this is probably going to help everyone in this scenario, is basically kind of knowing what you need to produce as far as documentation and having it organized ahead of time, so that way it helps you guys in the application process and everything.
Yeah. One thing that we really strive to do is do more work up front.
Yeah.
So that there's not
No headaches.
we're not chasing things on the back side of the transaction.
Right.
So it's pretty standard items. W-2s for the last 2 years, pay stubs for the last 30 days, bank statements for the last 2 months, and that includes all pages. And if you're self-employed, it's going to be the last 2 years with the tax returns.
Okay.
And because of the Patriot Act, we need to know who we're talking to. So driver's license, some picture ID,
Full
Social Security
identification.
number.
Yeah, that's absolutely very important as well. But those are pretty much the main guts of the documents that we would need to get.
Okay.
Yeah, basically it's a complicated process, but we try to make it simple.
Yeah, simplicity is great. So thanks for watching today. What we're going to do is we're going to have these guys back. We're going to talk about some improvement loans at some point here as well. So stay tuned for that, because I think that's very important in today's market with limited inventory. So keep an eye out for that. And if you want some additional information on these tips and kind of how to apply them to your own situation, as well as kind of what recommendations would be good for your situation, click the link that's in the description, and we're going to reach out to you with some information. And with that, thanks for watching.
Yeah, thank you very much.